Escaping compounding interest can feel like pushing a massive, heavy boulder up an endless steep hill with no relief. Lenders love to sell the idea of saving money on your mortgage, but that phrase is often a trap to push three entirely different financial products. If you have equity or some extra cash, you have probably felt paralyzed trying to choose between refinancing, recasting, or simply paying extra. These options are not interchangeable. They do completely different things to the math of your loan. Look at what actually changes. Refinancing alters your interest rate. Recasting lowers your monthly payment. Prepaying shortens your loan term. To see this in action, we are going to use a real-world example. A $334,849 loan balance at 7.25% with 26 years left. If left entirely alone, it will generate $410,088 in interest. Choosing the wrong lever for this specific balance leads to hundreds of thousands of dollars in unnecessary interest payments. Refinancing means buying a completely new rate and term. It requires a high upfront premium, a full credit application, and total underwriting. Let's say you pay $6,500 in closing costs to secure a lower 6% rate, and you reset the clock with a fresh 30-year term. This chart shows the baseline reality. The massive do-nothing bar climbs to $745,000 total, including $410,088 in pure interest. Refinancing drops your monthly payment by $341, but look at the new lifetime cost. The total height barely dips, saving a meager $14,675 overall. The math trap is the timeline. By resetting the mortgage clock to a fresh 360 months, you give compounding interest 4 extra years to eat almost all the savings generated by that lower rate. When taking out a new loan, the new term dictates your lifetime wealth far more than a simple drop in the interest rate. Recasting is built for the windfall recipient. If you receive a lump sum of cash and already have a favorable interest rate you don't want to lose, this is your tool. You deploy a $30,000 lump sum directly to the lender, pay a small flat fee of around $350, and skip the underwriting process entirely. In exchange, the lender recalculates your amortization schedule based on that new, lower principal balance. This forces your required monthly payment to drop. Applying a $30,000 recast brings in a third lever. Your monthly payment shrinks, saving $36,391 in interest. But look at the timeline below. The recast option terminates at the exact same 312-month mark as doing nothing. The unchanged payoff date heavily restricts interest savings. Recasting isn't truly about maximizing long-term wealth. You are simply paying a lump sum up front to buy yourself monthly budget flexibility and peace of mind. Now consider the final lever. You apply the exact same $30,000 lump sum directly to the principal, but you do it without paying any fees or asking the lender to recast the loan. The immediate consequence is that your mandatory monthly payment will not drop by a single cent. Your day-to-day budget gets absolutely zero relief. Watch what happens when that $30,000 destroys the principal balance directly. A fourth bar crashes down, revealing $129,970 in interest saved. Comparing both lump sum strategies side by side exposes a massive $93,579 gap between recasting the money and simply leaving your payment unchanged. This massive gap exists because direct principal reduction shaves years off the back end of the loan. It physically prevents the bank from charging you decades of compounding interest. Directly reducing the principal allows you to delete years of scheduled payments and escape the debt cycle ahead of schedule. Even smaller, consistent prepayments, like adding $300 a month or switching to bi-weekly payments, build up to this exact same terminal velocity over time. Prepaying is the ultimate interest killer for maximizing total net wealth. The trade-off is that it comes at the steep cost of locking your liquid cash permanently inside the walls of your house. Determining your best option requires matching your primary financial constraints to the specific tool that solves them. This decision flowchart maps it out. The starting point is simple. What is your primary financial constraint? If you require a lower monthly payment to survive budget pressure and you have a lump sum on hand, you follow the path to recast. If your primary goal is surrendering the absolute minimum to the bank over the life of the loan and you don't need immediate budget relief, you choose pay extra. Finally, if market rates are significantly lower than your current rate, refinancing becomes a viable path, but only if you meet one vital mathematical condition. You have to know your break-even point. You divide the total closing costs by your monthly payment reduction to find out exactly how many months it takes to actually start saving money. In our control example, it takes 19 months just to break even on the 30-year refinance fees. If you end up moving or selling before month 20, you lost money on the deal. General rules of thumb are dangerous when it comes to mortgages. You must run your exact loan balance, interest rate, and terms through a dedicated calculator to see the reality. Head over to the MiniWebTool guide to use their free, specific calculators. You can find your exact break-even thresholds and compare all three options side by side. Lenders sell debt, but you build wealth by understanding exactly which lever to pull. Be sure to subscribe to MiniWebTool for more definitive, mathematically proven financial breakdowns.